Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PENNYMAC Financial Services Inc. Annual Report. PENNYMAC Financial Services Inc. offers a wide range of businesses and services through its subsidiaries. At the core of its operations are mortgage banking and investment management activities in the United States. The company operates through two primary segments, production and servicing. The production segment is responsible for originating, acquiring, and selling loans, including residential conventional and government-insured or guaranteed mortgage loans. This is achieved through various channels such as correspondent production, consumer direct lending, and broker direct lending. On the other hand, the servicing segment performs loan servicing activities for newly originated loans that are under holding for sale and loans serviced for others. The company's services include loan administration, collection, and default management activities. These tasks involve collecting and remitting loan payments, responding to customer inquiries, providing accounting for principal and interest, holding custodial funds for property taxes and insurance premiums, offering counseling for delinquent borrowers, supervising foreclosures and property dispositions, and administering loss mitigation activities. In summary, PENNYMAC Financial Services, Inc. provides a comprehensive range of businesses and services in the mortgage banking and investment management sectors, including loan origination, servicing, administration, collection, default management, and loss mitigation activities. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of any company, including PENNYMAC Financial Services, Inc., can be influenced by various factors that impact its financial performance and market perception. Some common reasons for a decline in stock price include changes in the company's revenue or earnings, increased competition, regulatory issues, or shifts in industry trends. Additionally, external economic conditions such as interest rate fluctuations, inflation, or recession can also affect a company's stock price. In the case of PENNYMAC Financial Services, Inc., if its financial performance has been impacted by changes in the mortgage market, increased competition from other lenders, or regulatory challenges, it could have led to a decline in its stock price. Furthermore, external economic conditions, such as rising interest rates or a slowdown in the housing market, may also be contributing factors. It is worth noting that without access to specific information about PENNYMAC Financial Services, Inc., it is difficult to pinpoint the exact reasons for the decline in its stock price. However, by considering general market trends and company-specific factors, we can make an educated guess about the possible causes of this decline. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company in the mortgage servicing industry can be attributed to several key factors. Revenue growth is largely driven by loan origination fees, net loan servicing fees, and management fees. These segments have reported significant revenue growth, indicating a strong demand for mortgage servicing services. The company's substantial net income also reflects its profitability in this business segment. However, the company faces significant risks that can impact revenue growth or decline. Credit risk is a major concern due to the large amount of participation certificates issued by the company. This exposure can lead to potential losses if borrowers default on their loans. Additionally, off-balance sheet arrangements and acquisitions can also affect the company's financial performance. To assess the company's revenue growth prospects, it is essential to analyze its revenue mix across various segments. Understanding net interest expense can help evaluate profitability and interest rate risk exposure. Evaluating credit risk is also crucial in assessing potential losses due to borrower defaults or other credit-related events. By examining these factors, investors and analysts can gain a better understanding of the company's financial performance and make informed decisions about its growth prospects. Net income experienced significant fluctuations between 2021 and 2025. In 2024, net income plummeted by 61% compared to the previous year due to higher interest rates that constrained mortgage origination and refinancing activity. However, in 2025, net income rebounded with a substantial increase of 62% from 2024, primarily driven by revenue growth. Profit margins also underwent notable changes during this period. In contrast to the stability observed between 2021 and 2022, profit margins declined sharply in 2025 compared to 2024, decreasing by an alarming -119.7%. This downturn was largely attributed to interest rate volatility and wider mortgage-backed security spreads. The exact percentage increase in profit margins from 2021 to 2022 is not provided. The reasons behind these changes are multifaceted. Higher costs associated with servicing delinquent loans, increased servicing advances, and lower recoveries in foreclosure all contributed to decreased profit margins. Additionally, a decrease in management fees due to a decline in PMTS average shareholders' equity, coupled with an increase in compensation expense resulting from higher loan production volume and company profitability, further eroded profit margins. The company's financial performance indicates a concerning trend. According to the extracted summaries, the company has been generating negative operating cash flow in recent years. Specifically for the year 2025, the net cash used in operating activities was a significant $1,651,984 million, indicating a substantial outflow of funds from operations. Furthermore, the operating cash flow status is explicitly stated as negative, reiterating the company's struggle to generate positive cash flow from its core business activities. This trend suggests that the company may be facing financial difficulties and requires careful management to rectify this situation. The company's debt level and interest expenses have undergone significant changes. According to the data, the total liabilities increased by $2.8 billion, 12.6%, from 2023 to 2025. The net interest expense also saw a substantial increase, rising from -$4,853 in 2023 to -$36,108 in 2025. Furthermore, the interest expense on corporate debt rose significantly, increasing from $98,396 in 2023 to $291,562 in 2025. The company's average debt balance has also increased, rising from $3.4 billion in 2024 to $4.2 billion in 2025. This increase is likely a contributing factor to the significant rise in interest expenses. The data suggests that the company's reliance on financing activities has led to an accumulation of debt, resulting in higher interest payments. The overall trend indicates that the company's debt level and interest expenses have increased substantially over the past year. This may pose challenges for the company's financial stability and profitability in the future. The company's performance can be analyzed through its various segments and regions. In terms of revenue generation, the mortgage banking segment stood out as a strong performer, accounting for 85% of the total revenue in 2025. On the other hand, the servicing segment struggled to contribute significantly, making up only 15% of the total revenue. In addition to revenue performance, the company's cash flow also indicates areas of strength and weakness. Financing activities provided a significant boost, with net cash generated amounting to $1.61 billion in 2025. Conversely, operating activities were a major drain on the company's resources, resulting in a net cash outflow of -$1.61 billion during the same period. These results suggest that while certain segments and regions are thriving, others require improvement to achieve overall financial stability. Management is optimistic about the company's outlook, citing significant revenue growth of 29% from 2024 to 2025, along with a 62% increase in net income and improved earnings per share, EPS, of $9.30 in 2025. The diversified revenue mix across various segments, including loan origination fees, net loan servicing fees, and management fees, suggests a stable financial foundation. Management's strategy appears to focus on managing exposure to changes in interest rates through the use of financial instruments and derivatives. This is further supported by the company's entry into master netting agreements with counterparties to mitigate counterparty risk associated with derivatives. The acquisition of Sendler's subservicing business in February 2026 also indicates a commitment to expanding the company's services. Overall, management's outlook suggests that PENNYMAC Financial Services, Inc. is well-positioned for continued growth and success, driven by its diversified revenue mix and effective risk management strategies. The company has made several acquisitions and divestitures as part of its business strategy. Acquisitions include the purchase of mortgage servicing rights, MSR investments, and subservicing businesses. Specifically, the company acquired mortgage servicing rights in connection with the sale of loans to government agencies, purchased delinquent Ginnie Mae loans through an early buyout repurchase option, and repooled these loans into new guaranteed securities when they became current. Additionally, the company purchased the subservicing business of Sendler Capital Corporation for $172.5 million upfront, with up to $85 million in contingent consideration. In terms of divestitures, the company has sold mortgage servicing rights, loans held for sale, and principal-only stripped mortgage-backed securities. The sales were made under agreements that included repurchase options, allowing the company to reacquire assets if certain conditions were met. Furthermore, the company repurchased loans with identified defects due to breach of representations and warranties. The company's financial history reveals a consistent practice of rewarding shareholders through dividend payments. As indicated in various pages of the extracted summaries, dividends have been paid on multiple occasions, demonstrating a commitment to sharing profits with investors. In addition to dividend payments, the company has also engaged in share buybacks, further indicating its focus on returning value to shareholders. While the exact frequency and total amount of these transactions are not specified, it is clear that share buybacks have been a part of the company's financial strategy. Concerns about inventory buildup or supply chain disruption are evident in the provided summary. On page 28, there is a risk of holding too much inventory, which could lead to illiquidity and unfavorable loan sales. Additionally, inaccurate representations and warranties may require repurchasing loans. The data on pages 68 and 69 suggests that inventory buildup is a real concern. The increase in loans eligible for repurchase by $1.3 billion from 2024 to 2025 indicates potential issues with supply chain management. Furthermore, the decrease in inventory of loans held for sale in 2025 may be offset by an increase in financing activities and investment in MSRs. The interest income from loans held for sale has increased due to higher average levels of inventory on pages 65 and 66. This could indicate that companies are holding onto more inventory than necessary, which may lead to supply chain disruptions or inventory buildup issues. That concludes the financial summary for PENNYMAC Financial Services Inc. Feel free to comment below, and I will be happy to answer them when possible.